You've probably heard this question before. If war is bad, why do stocks go up? At first, it feels like something is broken, like markets are ignoring reality. Because in your mind, war should mean fear, fear should mean selling, and selling should mean prices fall. That's the simple chain most people believe in. But financial markets don't follow simple chains anymore, they follow pressure systems. And pressure systems don't behave the way intuition expects. Because on April 8th, something happened that looked straightforward on the surface. A ceasefire headline entered global news. Tensions cooled, at least temporarily, and within hours markets exploded upward. The S&P 500 jumped more than 2.5%. The Nasdaq surged nearly 3%. The Dow recorded one of its strongest single-day performances in over a year. Financial media immediately had an explanation. A relief rally. Investors, they said, were reacting to peace. Less fear equals higher prices. Simple narrative. Easy to digest. But the problem is, markets are not driven by narratives. Narratives are what come after, not what causes the move. Because when you look inside the structure of the market that day, something very different was happening. Large hedge funds were not aggressively buying, they were selling at a pace not seen in over a decade, which creates an immediate contradiction. If the largest players are selling, who is pushing prices higher? And more importantly, why is selling not pushing prices down? That is where the real system begins. Because modern financial markets are no longer purely opinion-driven, they are positioning-driven. And positioning is invisible until it becomes unstable. To understand this properly, you need to remove one assumption from your thinking, that news causes price movement. It doesn't, not directly. News acts like a trigger. But the real movement comes from internal structure already built inside the system. Think of it like a compressed industrial machine. You don't need to push it hard, you only need to release a small latch. And the system does the rest. Now let's go back before April 8th. Because the real story did not start with the ceasefire headline. It started days and weeks earlier. Inside hedge funds, macro trading desks, and systematic funds, positioning had been shifting aggressively. Funds were increasing short exposure across multiple equity sectors. Not because they had emotional views about war or peace, but because volatility conditions were changing. And volatility is something institutions actively trade. When uncertainty rises globally, volatility rises with it. And volatility is not just risk, it is product, something that can be priced, hedged, and traded. So many institutions began positioning for turbulence, for larger swings, for instability. But here is where the system quietly becomes dangerous. When too many participants position in the same direction, the market stops being balanced. And when markets lose balance, they become sensitive. Not slightly sensitive, structurally sensitive. Because when everyone is on one side of the boat, even a small shift in weight creates movement. And movement creates reaction. And reaction creates more movement. By early April, positioning data across derivatives markets showed something unusual. Hedge funds were heavily net short in specific exposures, at levels not seen in over a decade. Now, normally, this would be interpreted as bearish sentiment. But that interpretation is incomplete. Because short positions are not just directional bets, they are structural liabilities. A short position is created when a trader borrows an asset and sells it immediately. The expectation is simple. Buy it back later at a lower price. Profit from the difference. But if price rises instead, something very different happens. The trader is forced to buy it back, not because of belief, because of obligation. This is where pressure begins to build. And forced buying behaves differently from voluntary buying. It is faster, more aggressive, and more concentrated in time. Now add another layer, options dealers. These are institutions that sit on the opposite side of options markets. Their job is not to predict direction. It is to remain neutral. So they hedge dynamically. If the market rises, they buy stock. If the market falls, they sell. But their hedging is not optional. It is mechanical, driven by risk models, which means when volatility increases, their hedging becomes a source of market impact. Now combine this with short sellers, two separate systems, both converting upward movement into additional buying pressure. Now add a third layer, commodity trading advisors, CTAs. These are systematic funds that follow trend signals. They do not interpret news, they do not care about macro narratives, they respond only to price direction. If price rises, they buy, if price falls, they sell. Simple rule systems. But when placed into a stressed environment, simple rules become accelerants. Now we have three separate forces: short cover, dealer hedging, systematic trend following. Individually, each is normal, but together they create a feedback loop. And feedback loops are where markets stop behaving linearly, because in a feedback loop, price rises triggers buying, which pushes price higher, which triggers more buying, and the system continues until something interrupts it. Now return to April 8th, because by the time the ceasefire headline appeared, this structure was already fully loaded. The market was not neutral, it was compressed, which means even a small external catalyst could activate a large internal reaction. And that is exactly what happened. The headline did not create buying pressure. It released it. Short sellers began covering positions. Options dealers began hedging exposure. Systematic funds began chasing momentum signals. And all of this happened simultaneously. Not because they coordinated, but because their systems independently responded to the same price movement. This is where narrative and mechanism diverge completely. The media sees one cause. The system runs multiple forced reactions. Now let's attach scale to it. Across a short window, estimates suggested tens of billions of dollars in forced buying entered the market, not discretionary capital, not long-term conviction. Forced execution flows. Think about what that means. A hedge fund does not choose whether to cover a dangerous short position. An options dealer does not choose whether to hedge risk exposure. A systematic fund does not pause a trend signal. They execute. And when execution becomes synchronized across multiple systems, price stops reflecting opinion and starts reflecting constraint. That is why markets can rise during instability, because instability does not always reduce buying, sometimes it increases forced buying, and that is the uncomfortable truth. Now step back further, because this pattern is not unique to April 8th. It is structural. It appears in short squeezes, it appears in volatility spikes, it appears in rapid macro reversals, it appears whenever positioning becomes one-sided. Every time too many participants lean into the same assumption, the system becomes vulnerable to the opposite outcome. Because markets are not static, they are reflexive systems. They respond not just to information, but to internal structure, which means two completely different interpretations can exist simultaneously. One interpretation says peace headlines reduced fear, stocks rose. Another interpretation says positioning was crowded, force flows triggered a squeeze, stocks rose. Same chart, different mechanisms. Now zoom out further, because this leads to a deeper question. If markets can rise during fear, if instability can trigger buying, if negative events can generate upward pressure, then what exactly are prices reflecting? Are they reflecting economic reality, or are they reflecting internal positioning stress? There is no simple answer, but there is a consistent pattern. The more crowded the market becomes, the more fragile it becomes. And the more fragile it becomes, the less intuitive price behavior becomes, which means markets are not always mirrors of the real economy. Sometimes they are mirrors of internal imbalance, and imbalance always demands resolution. Sometimes slowly, sometimes violently. Now bring it back to headlines, because this is where most people get misled. When you read stocks rose due to peace talks, or markets fell due to war concerns, you are not reading the mechanism, you are reading the final layer of explanation. The system already moved long before the explanation appeared. Because underneath every major market move, there is always positioning, always leverage, always forced behavior. And sometimes the strongest rallies in markets do not come from optimism. They come from constraint, which brings us back to the original question. If war is bad, why do stocks go up? Maybe that was never the right question. Maybe the real question is simpler. What was already positioned in the system before the news ever arrived? Because that is where the real market story always begins.